Joining us is Dan Greenhaus, Chief Strategist and Managing Director at Solus Alternative Asset Management. How are you feeling, Dan, going into next year after we've chalked up another double-digit gain for the market this year?
I still feel pretty good. I keep talking about that. Yes, the calendar has turned, but what are the themes still at work? And the AI theme is still driving markets top to bottom. And we're talking about the SoftBank deal today. It's hard to imagine that this theme ends when you keep getting headlines like this of this size. And so I know everyone's worried about all the worries that we've expressed day after day, week after week. But at the end of the day, that theme still seems relatively in place for me. And with it, it probably continues to drive markets higher.
Which is just the sheer spend on AI?
It's the fact that we haven't fully adopted it yet. Companies are only beginning to sort of implement it in a meaningful way and get the productivity and efficiencies that are going to help support margins. But yes, the amount of spend and every single conference call that we listen to, every conference that these guys appear at, they all keep telling us demand is greater than supply. And at a minimum, you want to see, for this to end, you want to see that slow down. And I haven't seen any evidence of that yet.
No, there's been no let-up. Obviously, we're just through the last quarter in terms of all the hyperscalers and everybody else reaffirming or increasing their CapEx plans. That said, the bigger question, I don't know, are we going to get it answered in 26, which is, what's the return going to look like on all that invested capital?
I know everyone keeps talking about this, that this is the year where we're going to have to see the return. I don't know that that's the case. I mean, it could just be another year where we spend $1 trillion. Obviously, there's some differences because now we're tapping the debt markets to a greater degree than before. But as you know, all these companies have basically their leverage is basically a half a turn.
Many of them, not Oracle.
Oracle's the exception at the 3 or 4 times debt to EBITDA. But the Meta and the rest of them are called half a turn of leverage, so they're not particularly leveraged. So they can, and we know the IG market is 10 trillion in size, give or take. So there's ample room for this to continue. But I know, again, the main point is people keep saying we need to see, we need to see, we need to see. It seems like, to me, like a nice thing to say something different, but I don't know that that's rooted in any.
So we're just going to sit here next year, have the same conversation that we're having right now?
Why not? I mean, listen.
Now, what does that mean for the S&P?
Well, listen, this is the argument that as long as these companies are as large as they are, you need to continue to be, if this is what you do, it's not what Solus does, but if this is what one does, you need to continue to be exposed to those names because you're just going to underperform. But at the same time, we've seen, as everyone has noted, some change in allocation here. Some of those larger names have sold off. Even some of the derivative names like Eaton and Vistra and Vertiv have sold off, and other names have picked up the slack, healthcare, financials, some materials names. So you're starting to see a rotation. So that's really the question, I think, going into next year, not whether the AI story is going to blow up, but rather whether you want to continue to be exposed to the largest, most obvious names rather than something else.